Well, thank you all for coming, and thanks to the people who, thanks to the internet, are available to see this online. So this is work that Julie and I've been engaged with actually for about 25 years, off and on, but it's much better than it used to be. So this paper is aims to give a better understanding of implications for financial stability and monetary policy transmission for South Africa. So we want to improve the household sector model of consumption, house prices, and debt for South Africa, and hope to suggest improvements in the core model of the Reserve Bank, which has equations for consumption and private credit extension, but not household debt broken down in this way, and not for house prices. South Africa, of course, has specific institutions that really make a difference to this kind of thing. For example, it's the only industrial country where non-mortgage debt now is higher than mortgage debt. Almost everywhere else, mortgage debt is about 70% or more of total household debt. And we think there are lessons for emerging market countries, but also for countries in Europe, because the modeling methods and some of the mechanisms that we point to are relevant for other countries as well. So to make that point, it links with our recent work on the Czech National Bank, where we were asked to do one of the external reviews. And the existing model at the Czech National Bank is a DSG model, which doesn't have banks in it, it doesn't have credit in it, it doesn't have asset prices, doesn't have a housing market, doesn't have money. So it excludes everything that Charles Goodhart once said is of interest, to him at least. It uses a representative agent model to represent the household sector. And these models are now quite discredited by all the work that's been done on heterogeneous agent theory. It also makes some pretty incredible assumptions, like covered interest parity for the exchange rate, and the assumption that households make all the investment decisions, even though something like half of major companies in the Czech Republic are owned by foreigners. So, good thing that South Africa hasn't gone down this DSG route that the Czechs adopted. So let me talk about some of the institutional features that really matter. I mean, you probably know that South Africa probably has the highest unemployment household inequality in the world. One of the implications is, for example, the unemployment rate, which is 50% for young blacks, for example, is not a good uncertainty proxy because it has its structural features. Household vulnerability and distribution is going to be really important in thinking about how to interpret some of the equations that we come up with, particularly for the housing market and debt. South Africa has floating rate mortgages. Even 3-year fixes are virtually unknown in South Africa. And that makes it really quite different, more like the UK used to be. That implies pretty rapid monetary transmission through cash flow channel. When mortgage interest rates go up, people have less cash, borrowers have less cash in their pocket, they spend less. Savers, on the other hand, react more slowly and with lower propensities to spend to the fact that their returns have gone up. As I said, non-mortgage debt is high, and many households have impaired credit records on their unsecured debt. It's a country where home equity withdrawal, as in the US, the UK, but not in Germany, France, or Italy, is easy. And that has important effects because it means that when house prices rise, housing collateral expands, people can take home equity loans, which they can use for spending. It's also a country where, unlike in the UK, for example, people can access their pension pot to put into housing. Aggregate consumption in South Africa is typically more than 60%, most recently 64% of GDP. And so consumption is obviously a very large part of total spending in the economy. So it's really important in a model that the central bank has to have a good model for consumption. The private saving rate in South Africa has long been low. that means that South Africa is quite dependent on capital flows. So the exchange rate, interest rates relative to other countries, things like that matter a lot in South Africa. Data quality turned out to be a huge issue for this paper in terms of the actual grunt work that went into the paper. So we had to fix some problems with the income data. We think that when they rebased the national accounts, they made some mistakes in linking with previous data. We corrected for that. That affects pre-98 data. And secondly, as far as house prices are concerned, they were using a very defective measure, a very defective index that didn't properly mix adjust for different kinds of housing as the market evolved. And so we've managed to find some repeat sales indices from different sources. Some of the South Africans will be familiar with those sources. And we've linked those together to get a much better, much more accurate picture of house prices for the last 30 years. Just as a background, the Reserve Bank has two important functions. One is through the MPC. It's the opposite, flexible inflation targeting, much like the UK since about 2000. And then macroprudential policy. The 2017 Act introduced a governance framework for macroprudential policy. And Janine and Greg Farrell and I have just recently finished a paper examining the governance structure of macroprudential policy. That's an important part of their policy concerns. So what do? Well, we estimate a system of equations for the household sector. Is estimated jointly. In other words, all the equations are estimated in one go through maximum likelihood. And it's for aggregate consumption, house prices, mortgage debt, non-mortgage debt, and permanent income, a measure of forward-looking income in order to try to proxy income growth expectations that might have been in the minds of households. And basically, what we're doing is taking a very different view of the micro foundations of macroeconomics than is conventional in the DSG literature and was conventional in the life cycle permanent income theory of consumption. Well, as I said, that ignored liquidity and credit constraints, didn't include housing, had only a single asset net worth, and little role for income uncertainty, whereas we bring all those things in. I just did a two-page sketch of how the attitudes of the profession had changed since the global financial crisis to micro foundations of microeconomics. That was in a paper for the ECB in 22. Really quite profound changes, both in theory and in the micro evidence that's been marshaled to understand what's going on at a household level. Right, so our model is much more consistent with micro evidence, heterogeneous evidence, for example, on how marginal propensities to spend out of income vary by how wealthy households are. So households who have no assets typically have very high marginal propensity to spend out of income, whereas households with liquid assets who are wealthy have much lower marginal propensity to spend. And our model is very consistent with that view of how households behave. A big aspect of our work is that credit conditions for mortgages and for non-mortgage credit move differently. And in South Africa, because non-mortgage credit is now bigger than mortgage credit, that is particularly important. And what we do is we follow what is called the LIVES approach, the latent interactive variable equation system. Well, a latent variable is a variable that's joint to all the equations that you don't have direct evidence on, that you get indirect evidence from the behavior of the system. And the interactive aspect is because some of these latent variables interact with variables in the model to produce interaction effects. So let me give you some of the big picture numbers. You know, what does the economy look like in terms of the variables that we're interested in? So this is the ratio of consumption to household disposable income. the black line. And you can see that there was a big increase in the consumption to income ratio in the period of democratization. Mandela was released in 1990. 94 was when the ANC came to power, and then a big jump in the consumption to income ratio in the boom before the global financial crisis, and then a contraction. The black line is what we've done in terms of splicing our data, our vintage data, with the later data from the SARB. The red line here is what the current version of the data in the SARB database says the consumption to income ratio was. You can see it's volatile and all over the place. And we really don't know what has gone wrong, but something's gone wrong. Well, our index of house prices relative to income moves like that. So there are only two turning points in this sample, which is a bit of a problem for econometric identification, practical identification, because two turning points, really like a few more. Of course, if we went back further, we could do better. But the data, the repeat sales data, really become less and less reliable from about here onwards. So we can't. Yeah, but just to make the point, there was this huge house price boom in the 2000s, and then a collapse. That's part of the story that we explain. Corresponding to that, the ratio of mortgage debt to income, that's the blue line, also shows this great peak in the 2000s before the financial crisis, then a collapse afterwards, and a more moderate movement here compared to the way house prices moved. Non-mortgage debt, that's the green line, big jump here with that coincides with the ANC coming to power, democratization, the pressure on banks to improve financial inclusion, and liberalization here. But unlike the huge contraction in mortgage debt after the global financial crisis, non-mortgage debt is kind of, it moves about a bit, but it's sort of flat. And then liquid assets to income, that's here. Surprisingly, when things were quite good, people didn't save a lot more. Housing wealth relative to income moves rather like house prices relative to income. This big rise and then a fall. Illiquid assets, so that's the financial markets. You can see that share prices really rocketed in the 2000s in South Africa, and this big rise in financial wealth obviously accounts, you would have thought, for some of the rise in the consumption of income ratio that occurred then, but we need to separate out the importance of that factor and all the other factors that were going on in explaining the rise in the consumption income ratio.
John, you've labelled that illiquid financial assets.
Illiquid financial assets, that's
not liquid.
Illiquid.
Illiquid.
Yeah.
So how do I
So the liquid ones,
that's not equity.
The liquid assets, that's the black line.
Yeah.
That's basically household deposits, saving deposits, bank deposits.
Sure. Could that be investments in the stock market?
Could that be invested in the stock market?
Could it be investments in the stock market?
No, the stock market investments are not in there at all.
Okay.
Liquid assets, yeah.
Right.
So illiquid assets will include directly held shares. Actually, this measure exclude pension funds, right, but there are alternatives that include pension funds that have a broadly similar profile. Well, investment trusts, for example, would be in there, directly held.
I think of those as liquid, but that's fine.
Yeah. Illiquid,
pension funds not.
Illiquid has two aspects. One is transactions costs.
Yeah.
And the other one is uncertainty. So the asset price uncertainty. This is the picture for inflation and the prime rate. So South Africa's been a high inflation country compared to what we're used to in the industrial world. The blue line, annual inflation rate, annual inflation rate of 12% early on, falling to about 7%, 5%, but those kinds of numbers. That's still pretty high. And partly as a result, the prime rate, which is typically 3% above the policy rate, has always been pretty high. So we've never got to the stage of negative nominal interest rates, which in some Western countries we got to after the crisis. So let's move on to consumption. So the standard textbook model looks like that in its log linear approximation. So it says that log of consumption depends on the asset to income ratio and on permanent income. So you can see the negative part from here and from here, they cancel out. It's just a way of writing it, make it explicit. There could be a role for current income, but it actually cancels out by looking at the permanent to current income ratio. Assets are net worth, liquid plus illiquid financial assets plus physical wealth minus debt. So in contrast, so before we put all these other things in there, flexible income expectations, controls for loan standards, splitting up the balance sheets to allow different kinds of liquidity to matter, controls for the house price to income ratio, and obviously much more consistent with a modern view of how macroeconomics works. And this is what a comprehensive model that includes everything looks like. The long run consumption to income ratio depends on an intercept that shifts over time with easier credit conditions or tighter credit conditions. That intercept shifts over time with the CCIs, the credit conditions. In black, I've put the things that turn out not to be relevant in South Africa. But in red are the things that are relevant. Income uncertainty, the ratio of permanent to current income, liquid assets, debt, illiquid financial assets, housing wealth, and the house price to income ratio. Let me say a word about the house price to income ratio, because when you think about owners and non-owners, when house prices rise, owners feel wealthier. And in South Africa, they've got this equity release option, which allows them to access more credit just on the basis of higher collateral, and they can spend that. So definitely a big positive effect, and a time-varying effect that depends on credit access. But what about the non-owners? Well, those aspiring to be owners realize they have to save harder to get that housing deposit, that mortgage deposit, to enter the mortgage market at all. And renters, well, they see house prices go up, housing markets are tight. They think, well, rent's going to follow. They're likely to be more cautious. So there's going to be a negative impact on the spending of the non-owners of higher house prices relative to income. That negative effect also shows up in Germany and France, for example. Right, so that's the key story. Different coefficients. And gamma 2 is obviously going to be negative. Higher debt means obligation to pay back in the future, debt service costs, and so on. Negative implication for consumption. Liquid assets, well, that's money in the bank, cash. You can spend that very easily. It's going to be more spendable than your pension, for example, or your stock market wealth. So that's the story. And then we have a house price equation. Now, where does that come from? Well, in the literature, which my authors and I reviewed in the Journal of Economic Literature a couple of years ago, the story is that you have to think about the inverse demand function. So think of the demand for housing. That depends on the price of housing, but also on demand shifters like income and interest rates and credit and so on. Now, housing, aggregate housing in the short run is pretty much fixed. Whereas what's endogenous, what varies a lot over time is the price. So you turn the demand function around and make price the dependent variable, and the quantity of housing is one of the drivers together with the shifters that explains prices. So that's the story. It's an indirect demand function. And the real price of housing depends on credit conditions, on user cost, which is a measure of the interest rate, but subtracting from it expected depreciation that you hope to get from higher house prices in the future. This is the key supply and demand factor. A negative relationship with the housing stock. The more housing stock there is, the lower house prices will be, other things being equal. But the higher income is, the higher house prices will be, other things being equal. Permanent income expectations, demography, and the property tax in South Africa is quite important. That's it. And then mortgage debt. And mortgage debt is something that there's very little literature about. Apart from some of the work that I've done in the past and some work that Jeff Mead at Reading did decades ago. How do we think about mortgage debt? Well, obviously credit conditions should be important. The nominal interest rate should be important. There was cash flow constraints. What the debt servicing costs are depends a lot on how, has a strong influence on how you can finance your mortgage and therefore how much debt you're willing to take on. Possibly the real interest rate, income expectations, and then house prices. The higher house prices are, you would have thought it's pretty obvious, relative to income, the more debt you have to take on in order to enter the housing market. Now, there is a downside to that, which is that if affordability becomes very difficult, some people will be excluded from the mortgage market altogether. So there's an extensive margin and an intensive margin, two aspects of that. The housing stock as well, because the housing stock represents you need credit in order to invest in housing. It isn't just the price, the higher price that matters, it's also the volume of housing that matters. And demography. So that's the story. So we're going to test, estimate the parameters of the model, and M5, the impact of higher house prices on mortgages, turns out to depend quite heavily on credit conditions as well. So there's an interaction effect there, which is part of the reason why we call this the latent interactive variable equation system. It's that interaction effect that's really crucial here, as well as consumption. And then there's non-mortgage debt, and it turns out, again, there's almost no literature on non-mortgage debt, time series literature. We've got quite a very simple model in the end. I mean, in principle, there can be a lot of factors at work, but we find in the end that it's credit conditions, it's the interest rate for consumer credit and demography, and then there's some short-run effects in there as well. Right, now, permanent income. This is really quite a big story for us because in the literature, the permanent income life cycle hypothesis had such huge sway in the textbooks, in central bank models, and so on. So it's really important that we don't ignore permanent income as a concept. And the way we construct permanent income is by taking, in logs, a declining weighted moving average with a horizon of 10 years, 40 quarters, with a discount factor of 95% per quarter, which is similar to what the US Federal Reserve model assumes, and also the ECB model assumes, far below the textbook assumption. Imagine if the real interest rate were 4% per annum, then the quarterly discount factor would be 0.99. That's a very different discount factor from the one that we use, which takes account of the fact that, of course, income is much more volatile than the textbook assumption. People are very uncertain about the future. It's difficult to forecast income beyond a few years. And so that declining weighted construct really makes sense. So we use a reduced form model to explain that econometrically. In our past work, oil prices, real oil prices, all types of trade, interest rates, demography, either equity prices or house prices as indicator of what the private market thinks about the future, are quite important in explaining the fluctuations over time of income expectations. Now, in the real world, of course, households can make huge mistakes. And those mistakes can be really large when unexpected events happen that change the trend, the underlying trend of how income evolves. And good examples of that, of course, are the global financial crisis, after which growth collapsed around the industrial world, the COVID pandemic, Russia's war in Ukraine, and in South Africa, the peaceful transition from apartheid in '94 was a positive surprise that households didn't fully anticipate. And so we have to take into account the difference between what an econometrician, now looking at past data, could figure out would be a good model, and what households or econometricians at the time could have possibly found to be a model, not knowing that these future shifts in trend were going to happen. So what we do is we introduce these split trends into our model, but then we remove their effects when we look at the fitted value of permanent income up to the point where the shift, where the break took place. So in other words, take 94. In 92, 93, people would have been quite pessimistic about the future because they didn't realize that there was going to be this peaceful democratic transition. And so what we have to do is remove from the forecast made up to 94 the fact that our model, our model that takes into account later data, has this fantastic upward shift in the income growth path. But we have to remove that shift from the expectations that households are imputed to have had before that shift took place. So that's the basic idea. And we assume a mix of rapid and slow learning takes place over 2 years once the shock happens. The global financial crisis was such a huge shock, and the stock market, collapsed, panic around the world. Obviously, it would have been very, very rapid learning for some of that time, and then we assume it was rapid learning for a bit, and then slower learning over a period of 2 years to figure out where the new trend of income was going to be. So that's the idea. In South Africa, in terms of trade, real interest rates, the log house price to income ratio, split trends give a very good fit. So permanent income looks like that. It's very smooth, because remember it's a moving average over a 40-quarter period. So 38 out of 40 quarters are going to be in adjacent periods. 38 out of 40 quarters data are going to be the same in adjacent period observations of permanent income. This is the actual log. That's log permanent income. The blue line is current income. You can see that there is a relationship between current income and the smooth permanent income. And our fitted equation fits the smooth line remarkably well. But this is what the learning adjusted expectations look like. So in other words, the pessimism that was there before the ANC came to power, before the democratic transition, suggests that people were quite pessimistic. Then there was this rapid adjustment once the democratic transition happened, so the new reality. And similarly, in the run-up to the global financial crisis, people were over-optimistic up to the crisis, and then adjusted their expectations downward quite rapidly when the crisis hit. So that's how we represent income expectations. Credit conditions. I mentioned credit conditions being a really important part of the whole story, often left out in the semi-structural central bank models, mostly because of data difficulties. And we think it's important to try to include them. Now, of course, there's a lot of data out there that are relevant for credit conditions. For example, there are bank lending surveys, data on bank deposits. That's the asset base of the banks. When that expands, you'd have thought they could lend more easily. Non-performing loan ratios. Sometimes in some countries there are granular data on loan-to-value ratios, debt service ratios in the mortgage market, credit spreads, and we know about political and changes in legislation. Macroprudential policy itself affects credit conditions. So in principle, there's a whole host of relevant information that could be used, but we want a single index for each type of credit to summarize all that. And we use the LIVES method, making as much use of this background information as we can. So MCCI and NCCI are latent variables, the linear functions of smooth transition dummies, and they're estimated in our system. These transition dummies give from 0 to 1 over an 8-quarter period, so they have this S shape, the smooth S shape. When we put different dummies together, we can get a smooth curve. So this is formally what those equation specification for each of these latent variables, with the SDs are these transitioning dummies and the Ds are the coefficients. So what do we find? Well, in this slide, I put together a mix of what we know, sort of from prior information, qualitative information, the history of the country, what we know, what previous estimates suggested, and I put that together with what we actually find, which is very consistent. So in our earlier work, we used data that showed there was a very definite liberalization in the 1980s. A very flat profile in the period 1994, then liberalization, easier credit, 94 to 97, then the major tightening in the emerging market crisis, and really easing around about 2004. That's what our previous paper that ended in 2004, 2005 actually, showed. From 2000 onwards, the Reserve Bank has data on credit spreads in the mortgage market. There's also loan-to-value ratios for all mortgages, not first-time buyers, just all mortgages. And they agree pretty much up to about 2014. They suggest major loosening after 2002, when there was a surge in corporate bank deposits. This is a period when the economy is growing very strongly. Companies are making large profits. They don't want to reinvest them immediately. So bank deposits at the private banking sector from corporates surged. And obviously that means there's more stuff available for the banks to lend out, and they chose to lend it out to households. And then major tightening after the global financial crisis. As far as non-mortgage credit conditions are concerned, there's clearly a substantial easing in this period up to the democratic transition and tightening in the emerging market crisis. After the emerging market crisis, South Africa went through a very bad crisis of its own, an exchange rate crisis. In 2000, interest rates, the prime rate went up to, I think, 23.5%. There was an exchange rate crisis. Obviously, did a lot of damage in the economy. Some smaller banks got into difficulties because there had been this lending spree of unsecured credit, pretty uncontrolled. And partly as a result of that, the National Credit Act came in 2005. So as I showed you earlier, there's the actual numbers, the actual shape of non-mortgage credit and mortgage credit. Non-mortgage credit didn't collapse in the way that mortgage credit did after the global financial crisis. So that's interesting distinction. This is the picture that emerges from our latent variable estimation exercise. As I said, estimated from the system as a whole, and mortgage credit conditions look like this. There's a big expansion, or a big easing of mortgage credit in this 2000s period. Major contraction after the global financial crisis, and a bit further here, probably because the Reserve Bank was being far tougher on macroprudential regulation and microprudential regulation. In this earlier period, the two moved in the opposite direction. There's obviously a shift away from mortgage lending, which up to then had been mainly to white households. A big shift because of the demand for financial inclusion to black households. And that meant that non-mortgage credit became much more easily available, but that resulted in a shift away from mortgage credit extension by banks. And again, as far as non-mortgage credit is concerned, this liberalization in the 2000s after the Credit Act, stasis here. So despite the global financial crisis, it seems like conditions for non-mortgage credit were pretty steady. And then after another banking crisis here, quite a sharp change. Right. So moving on to some results. Now, there's a lot of detail here, but let me point out some key issues. So one is the speed of adjustment of our consumption function is 0.42, with a T ratio of 13.4. Now, what that means is that long-run solution is very well specified. So in other words, it really works extremely well. And far higher than in the SARB's comparable consumption equation. The weight on permanent income, that says that about households put about half the weight on permanent income that you would expect from the strict life cycle model. The life cycle model says it's all permanent income, but in the real world, it's only about half of permanent income, but compared to current income that matters. Liquid assets have a much higher marginal ability to spend than illiquid assets. Housing affordability has a very, very clear negative effect on consumption, and housing wealth has a very strong interaction effect. So the interaction of credit conditions and housing wealth. As credit becomes more easily available, people can refinance their higher mortgage collateral very easily and spend it. So that's what that says. So, in terms of what the implications are, how important are these different factors in telling the big story? Well, this is unraveling a great pile of spaghetti. But it's actually very, when you go through it, it tells you an awful lot about what's going on. So the black line is the consumption to income ratio, the log ratio. So the big rise here in the run up to the ANC coming to power and afterwards. And then in the boom, the pre-global financial crisis boom in the 2000s, big rise there, and then it sharp falls. So, our model says that financial factors, illiquid assets over income, well, that's the red line. It did contribute some of that rise in the consumption to income ratio. So the fact that stock markets were doing so well here helped to contribute. But actually, there's a big offset, which is that net liquid assets minus debt, because debt was rocketing up at this point, that produces a negative countervailing force that offsets some of the positive factors from elsewhere. Permanent income, it's quite an important part of the story. The fact that permanent income expectations proved so positive at this period explains quite a lot of why the consumption income ratio rose, and the fact that permanent income is so much more negative relative to current income. More negative income expectations explains quite a lot of the decline in the consumption income ratio. So that's sensible. And then in terms of the actual credit conditions themselves, this is the blue line is the direct impact of mortgage credit conditions. The green line is the direct impact of non-mortgage credit conditions. And the red line, that's the combination of the time-varying impact of housing wealth relative to income and of the negative impact of the house price to income ratio. So it's the joint combination of what's happening in the housing market and the credit market. And you can see that's an important part of the boom here in the consumption income ratio is explained by the rise in that joint contribution from the housing market. Time is pressing on, and let me just briefly go through a few key points from the other equations. So the house price equation has a speed of adjustment of about 0.1, about 10%, pretty comparable to other studies. There's an important user cost effect, interest rates matter, with house price expectations mattering. Income expectations matter. One of the problems is that we have to stick in a negative trend to make sense of it. And we don't quite know why that is, but we have 4 hypotheses. The growth of the housing stock might be underestimated in the official statistics that we're using. So if that were the case, the greater the growth of the housing stock, the more the negative impact on house prices. But if it's underestimated, then you're underestimating the negative impacts. You need a negative trend to compensate for that. Maybe there's some emitting demographics, but I think the most plausible things have to do with the democratization, the post-apartheid nature of South Africa. There was a big drive of people into the cities after the movement restrictions for apartheid were relaxed, and the incomes of people going to the cities would have been a lot lower than average incomes. So the relevant income for explaining the increase in demand for housing is lower than average incomes in South Africa. And because of the removal of restrictions, probably the mismatch between supply and demand is also a lot less. And that together, I think, suggests why the model as a whole needs this negative trend to explain what happens to house prices. Mortgage debt, non-mortgage debt, well, fairly sensible stories. Econometric robustness, very good parameter stability. We have some slight doubts about the repeat sales index at the very beginning of the period, because we think it's implausibly, the increase was implausibly high. We tried different models for permanent income, pretty robust. We've had different versions of what goes into illiquid financial assets. So whether you include pensions or not, turns out not to matter very much for the overall model. It matters a lot for the model propensity to spend out of illiquid assets. There's some serial correlation in the house price equation. We suspect that the method of construction in the repeat sales index introduces some artificial smoothing of the data that's being reflected in that. So general conclusions. First of all, as I said, it's a much more general view of the micro foundations of household behavior and therefore of monetary transmission than the models that were popular before the global financial crisis. Conventional approaches fail to account the importance of loan standards and therefore have little relevance for macroprudential policy. So I've already explained what the key things that we control for that the conventional models didn't. South Africa is lucky in having better data than most emerging market countries on household balance sheets. And we, in our earlier work, actually helped a great deal in getting those data together and getting the Reserve Bank to adopt good data on household balance sheets. So our work suggests there are 7 different channels of monetary policy transmission. That was how interest rates transmit into consumption. So the first one is through income growth expectations, because income growth expectations are strongly affected by the real interest rate. Also affected by the house price to income ratio. Both of those, house price to income ratio is sensitive to interest rates. That's another one. House prices have a dual role in transmission because there's the owners and the non-owners, as I explained. For the owners, the rise in housing wealth from higher house prices is positive. For the non-owners, the rise in making housing less affordable is a negative. Credit conditions. Well, think about this. A large rise in interest rates triggers a downturn and banks' non-performing loans rise, particularly if previous credit conditions have been very loose. This is a classic credit cycle. Then lenders tighten credit conditions, households and firms have negative spending effects. I'll come back to that in a moment. There's a cash flow effect, as I explained, and our model shows that. Strong cash flow effect from the change in the prime rate on consumption. It takes about 2 years for that fully to feed through. Relatively fast transmission through prices of financial assets. We don't model that, but we think it's pretty fast. And there's also a volume effect. So when interest rates rise, people's debt eventually goes down. Their liquid assets, their deposits go up. And that affects, through those portfolio effects, eventually affects consumption. But all of that takes a long time. This takes a long time for the volumes of those asset ownership, the portfolios to change. And then current income. The model says about 50% of the weight is on current income. And current income, of course, is affected by everything in the economy. Exports, imports, investment, employment, all the things that are affected by interest rates that feed through into household income. So the core model differs a great deal. As I say, the speed of adjustment is far lower than ours, suggests underestimation of the speed of transmission of some of the shocks. That very low speed of adjustment, in our view, is a classic sign of omitted variables. Pretty low estimates of transmission from interest rates, and not very well estimated either. Income expectations are missing in the model, so that long-run effect of the real interest rate that we find on income expectations feeding through into consumption, that's missing in the core model. And we also find that interest rates are transmission through the house price channel and the credit channel, the way they interact, particularly the fact that it varies over time depending on credit conditions. That's missing in the core model. So our model is saying that in the 2000s period, 2002, 2006, at that point, the transmission mechanism from interest rates to consumption was very powerful because there was a strong effect on house prices and hence to consumption. But that depended on very easy credit availability. So this interaction of loose monetary policy and loose credit is an important insight that our model has. And then finally, macroprudential policy. Just think about the classic credit cycle. And that's exactly what we saw in South Africa in the 2000s. a classic credit cycle. After loose credit conditions, when negative shocks arrive, bad loans mount, lenders' appetite to provide credit to the private sector shrinks. In fact, we can actually show that our estimates of these credit conditions indicators, loose credit conditions, are very significant in forecasting future, actually not NPLs, but the credit impairment ratio, which is something very similar. That's the amount banks put aside when credit goes bad. So we can explain, forecast 1 or 2 or even 3 years ahead, how the credit impairment ratio is affected by loose credit conditions, combined with other things, economic growth, house price to income ratios, and things like that, interest rates. So a jump in the impairment ratio then sees credit tighten rapidly. That leads to a downturn, high levels of bankruptcies, home repossessions, loss of jobs and income. All of that happened in South Africa after the global financial crisis. And interesting enough, in South Africa, the banking system is oligopolistic, profitable, and was capitalized well enough to survive an otherwise damaging recession. So in South Africa, the consequences of the big banks were relatively minor in terms of their survival compared to the UK, the US, and other economies. So despite the fact that they survived, you can still have a credit cycle like that that has important consequences. So let me stop there. I could have gone on to talk about agent-based models. Oxford has a leading presence in the agent-based model. It's the wave of the future, agent-based models, and what we've been doing, I think, has important implications for how you treat the household part of an agent-based model. But that's a story for another time. Thank you. I'd like to online questions. But how? Yeah.
I've got two questions. I've got a fun question.
Yeah.
And I've got a technical question. Which one would you like first?
The fun question.
Fun question. Okay. What do you think about the UK pursuing equity release? I know there's some equity release, but it's very limited in order to pursue growth.
Well, the UK has had a balance of payments deficit every year since 1994. So the UK as a whole is spending more on consumption than it is producing. Very different from Germany, for example. And stimulating consumers as the driver of future growth isn't quite optimal. I think we should be focusing much more on investment. But of course, to get investment going, we have to have strong aggregate demand or some other sources, infrastructure investment to drive investment forward. So I'd be cautious about liberalization, going back to the liberal regime, the pre-global financial crisis liberal regime, to encourage household spending. Okay, and the final question.
My technical question.
Serious question. Then.
Yeah, my serious question was about the model estimation. So you mentioned that you use maximum likelihood estimation. Yeah. I imagine it's in an appendix in your paper. Yeah. So because I sort of naturally think about what you presented as probably a generalized additive model. If you're familiar with those, that's a generalization of the generalized linear model, where I have smooth functions of my explanatory variables. You might think about that. So I don't think you quite use that. They've been around since about 1990. Yeah. And I can estimate those using maximum likelihood estimation, but I want to know what's your system look like? What have you done there? Yeah. I mean, that's the long answer is long. Right. So we the functional formulas I put up for the different equations, that they're all in the program. Okay? So that there's a whole set of parameters, and then the optimization procedure is trying to find the best estimates of those parameters. Yeah.
Now, practical identification is of course much more difficult because we have the latent variables to identify as well. And we don't have direct information on latent variables. We have some priors.
Yeah.
We know that in certain periods there must have been liberalization, in other periods there must have been tightening. We know that, but we don't know the extent of that. And so the extent is being picked up, but the priors are being imposed on those dummy variables in order to get practical identification.
Simpler than that. In order to maximize the likelihood, I need to write down the likelihood. So what does the likelihood look like?
Okay. Well, it's each equation has an error term. So the joint distribution of those error terms is assumed to be normal, and effectively we're minimizing. It's like generalized least squares. It's similar to generalized least squares. We're minimizing an objective function where the covariance matrix of residual errors is part of the thing we're minimizing.
Sure.
So the likelihood it involves all those cross correlations between the error terms.
So it's fine. I can put a negative sign outside the likelihood and minimize that and get the same. Get the same lots, or even better, take logs. That's they're generally more stable. So minimize the negative log likelihood. So I think I've got an inkling of what you're doing. And is that in the paper that you're going to produce?
Well, the paper does mention the software that was used and
what software did you use? Do you mind if I
actually something very ancient software called TSP, Time Series Processor.
Oh,
the macro version.
Sorry?
The macro version by Bonner and Hall.
Yeah. But the more recent version of that they've developed into is called eViews.
Oh, eViews. Okay.
It was the originator of the eViews software.
Right.
eViews software developed out of TSP.
I have to get you using R or Python.
Well, yeah, or R would be.
R, that's what I said.
R would be.
You need to use R or Python. It's very easy. It's easier than using TSP or eViews. Anyway, sorry, I don't want to hold the conversation.
It's a program language. You just program it yourself. It's not a menu-driven thing.
So neither is R nor Python.
Yeah, I know.
Yeah.
I'd like to ask you about the house price index.
Yeah.
So you spent a lot of time using repeat sales data, which you got from First National Bank and from some others, and Lighthouse, is it called Lighthouse? Lightstone, sorry, private company, in order to produce this more believable house price index. Where would you recommend the South African Reserve Bank go with that? I mean, is a repeat sales index the way to go for them? Since it was quite an integral feature of the system.
Okay, so the Statistics South Africa has recently, in the last few years, been starting to estimate hedonic models of house prices, where they take into account different characteristics based on mortgage lending data from different providers. That's one way of controlling for the changing composition of the housing market over time. So you need something like that. The repeat sales approach is very popular in the US. So all the major US house price indices are based, Case-Shiller and so on, are based on this repeat sales methodology. That's where you compare house price now with the previous transaction for that house. So you need very good deeds office or land registry data on transactions going back a long way in order to be able to do that. And part of the reason why our data become less reliable in the early 90s is because there are many fewer observations. But repeat sales is the way to go in South Africa, given you want the longest possible historical record. It would be lovely if ABSA, which was the bank that was originally Barclays, it would be lovely if ABSA could release, the microdata they had back in the day, before 2000, to get further information about how things have been developing.
they've got it. Question,
Well,
they do
we're
have
trying
it,
to
they
work
won't
it.
release it.
It's probably not in digital form, it's probably in paper records. And then to do a sort of retrospective mix adjustment will be quite hard. But, you know, we really are stuck, you know, there's no reliable information about house price indices before about 92, 93.
How are you including the informal economy in this paper?
Yeah, well, the informal economy obviously is a very important part of what's going on. It's there in the background in trying to interpret things. So, for example, one of the things that we find is that in contrast to countries like the UK and the US, when credit liberalization happens, you expect people to become more forward-looking. Because, you know, they can do intertemporal optimization, they can borrow very easily. You can advance expenditure in advance of higher income. In South Africa, there's no evidence at all of any shift in coefficient of permanent income with liberalization. If anything, it's the other way around. How do you interpret that? Well, I think it's because poorer households integrated into the credit markets. You know, these are households who are not very sophisticated, and of course they're poor, so they're credit constrained. They don't have the ability to look forward into the future, and so, you know, that's one aspect of that. Of course, the informal. Sorry.
Oh, I was just going to draw your attention to Jagoda's question in the chat box.
Oh,
Next.
where do I see that?
On the far
Oh,
right,
there it
John.
is.
Yeah, because I would like to hear more about consequences for the ABMs.
Well,
The final slide.
yeah, if
How should we model consumption within the ABM approach?
sorry, let me just finish on that. Yeah, so another aspect of that is that in the informal economy in South Africa, you know, there's a lot of housing provision in people's backyards, in shacks. Now, as that housing provision expands, that's going to affect the supply and demand for housing as part of the overall picture. And it's not at all clear that the official data are doing a good job of measuring that kind of backyard investment in informal housing. So that's one aspect of how the informal economy has an impact and maybe distorting the interpretation of the data that's being collected from the formal economy. But that's an aspect of the reply to your question.
So so how do you include that in the other term in the point?
Well,
The other term is probably larger than the signal.
well, don't forget the distribution. Inequality of income distribution, of expenditure distribution, has some unfortunate implications. One of them is that it's the highest earners and the highest consumers who account for much of the aggregate data that we observe. In other words, the formal sector is accounting for much of the data that we are modeling. The informal sector, because people are so poor, their consumption is so close to subsistence, that doesn't have a very high share in total spending. Obviously, it's going to be there in the background.
Where's the microphone? Because people are complaining that they can't hear. So if
Well,
you
maybe
just-
you've just drifted a bit
Yeah,
far
maybe
forward.
where exactly is it?
Yeah, it's there above John.
Oh, John, look, the
might be
microphone is
that you-
above your head there.
But
Look
it-
up.
Oh, there.
Yeah, so
But
you
it-
better move back so because people are complaining that it
Okay.
mix up. They
It might
can't
be
hear.
that they can't hear the question, so you repeat the question when
Yes,
the
yeah.
question's made. But you are getting a lot of questions on the
Okay.
chat as well, so I'll
So-
maximise that for you.
Yeah.
So
Yeah. Depends on how long.
it's up to you, yeah, if you want to stay behind and
take a
keep
few
taking these
questions.
questions.
Yeah.
Can you read that?
Oh dear. Right.
So Jagoda on the ABMs.
Yeah. So let me skip Yogoda for a moment because I can have Yeah, just for the moment.
You're going to,
Let me go to the
you're
Saab
going to the
question.
co-author of John's, and he can talk with you about this in due course.
Yes.
And maybe respond by email, John,
Yeah,
if
yeah,
there
yeah.
isn't time now.
So the lengthy Saab question.
Yeah.
Okay, the question from the Saab, MG Ferreira. Disaggregating into durables and semi-durables, non-durable services is a good idea. The aggregate equation that we put forward here could certainly be broken up into some of these different components, and then the relative prices of, for example, durables to non-durables or the services is going to be an important part of the long-run solution. We haven't done that, but it's certainly something that could be done with this kind of approach. So if you break the relationship between the one-to-one relationship, the Saab core model imposes a one-to-one relationship between consumption and income. Now, in our model, that's also true. In the long-run solution, has a one-to-one relationship, but it's not just with income, it's also with permanent income and with portfolio ownership of households and with credit conditions. So, there are a lot of things in our long-run solution that are different from a much simpler long-run solution that's in the Saab model. Strong autocorrelation doesn't influence the long-run solution. Well, the autocorrelation that we pick up is in two places. One is the house price equation, where we think the method of construction of the house price index involves some smoothing that generates this autocorrelation. The Watson there is 1.3 or something like that. Now, the other place, of course, is in permanent income. As I pointed out, with permanent income, 38 out of 40 adjacent observations coincide. So that means the residuals have to be very highly autocorrelated. There's no way of avoiding that. So that means the T ratios can't be interpreted directly. You have to halve them roughly, or divide them by 2.5 roughly to get adjusted T ratios. But all our T ratios are so significant in that permanent income model that we're quite sure that they're relevant. And it doesn't seem to have much impact on the long-run solution. Also, we can play around with different formulations for permanent income and get very similar results. So it's not very sensitive to the exact formulation of permanent income. I hope that answers some of those questions. So let me turn to Yagoda and just say a few things. There are recent developments in ABMs. Poledna, and Sam Wiese, of course, right here, which are very promising in terms of using agent-based models for short-term macro forecasting. But the linkages between housing and credit supply are not so well developed in these models. Whereas in the previous ABM literature that focused on housing and macroprudential, they're much more developed. So I draw 3 lessons from this for approaches like the Poledna work, the work at the Bank of Canada, and Sam Wiese's paper, which is integrate the models. In other words, combine the insights from the earlier work on housing and credit with these models. And the second one is that the consumption heuristics in these models are fairly primitive. And I think the formulation of a credit-augmented consumption equation would be a very good candidate for a consumption heuristic to use for households. The other problem with these models is that the medium to long-run dynamic properties are at the moment still quite poor. So the stock flow relationships and the treatment of expectations are going to be very helpful in improving the long run properties of these models. And our approach suggests some ways in which you could improve. And you know, I've got all kinds of things to say about that, but I will leave that for another time. Any other questions? Right. Well, because we've got 10 minutes.
John,
over,
we've only got 5 left, so I think
we
we have to wrap up.
can stop.